Today, we're diving into a massive economic shift planned for 2026. This is a big one because it could change everything from your mortgage rates to your savings account. Why? Because the entire leadership of the Federal Reserve is about to be reset.
And well, this statement from the White House really sets the tone. It's a clear signal that a major change in the country's economic policy is on the horizon, and the Fed is expected to fall in line with the administration's goals.
So, to get a handle on this, let's look at the timeline. Now, there are some legal challenges happening, but the date you really need to circle on your calendar is May 15, 2026. That's when the current Fed chairman's term is officially up, clearing the way for new leadership to step in. What this all creates is a pretty historic showdown, right? It's the president's economic agenda up against the long-standing independence of America's central bank. And the whole fight really boils down to one thing: interest rates.
So, what exactly is the Federal Reserve? We call it the Fed, and it's our central bank. But here's the detail that's so important right now: it is technically not part of the U.S. government. And that very independence is what's at the heart of this whole debate.
And this right here really lays out the two competing playbooks. See, on one hand, the Fed is supposed to juggle two things: keeping inflation in check and making sure people have jobs. But on the other hand, the administration has a much simpler goal: push interest rates as low as they can possibly go to get the economy roaring.
Okay, so let's play this out. What actually happens if the Fed gets told its new job is just to slam interest rates down? Let's trace the domino effect that this would kick off across the whole economy.
To get it, you've got to understand the federal funds rate. Now, this isn't the rate you pay on your mortgage. A better way to think of it is as the wholesale cost of money for banks. It's the starting point that pretty much every other interest rate is built on top of. So, when that wholesale rate gets cut, it kicks off a chain reaction. First, banks can borrow money cheaper. That means they can turn around and offer you cheaper loans on things like a house or a car. It also makes it way easier for big players to borrow, which often pours fuel on the fire for asset prices, things like stocks and real estate. But, and this is a huge but, there's always a catch to making money super cheap and encouraging a ton of spending. When you have way more money chasing the same amount of stuff, prices for everything tend to go up. And that, my friends, is inflation. We're just about to get into what this really means for your wallet. But hey, first, if you're getting some value out of this breakdown, do me a quick favor and hit that like button and subscribe to Stock Market Mojo. It really helps a ton, and it makes sure you don't miss what's coming next. This risk of higher inflation, it kind of splits the economy into two different teams. An environment with low rates and high inflation creates winners and losers. And it really comes down to whether you own assets or you just save your cash. I mean, just look at the story from the past few years. This chart says it all. Sure, wages went up, but not enough to keep up with inflation. Meanwhile, assets, represented here by the stock market, grew way, way faster than both of them. And this really makes it crystal clear. When inflation is running hot, the cash you have tucked away in a savings account buys less and less every single year. Its power just evaporates. But for people who own assets, like stocks or a house, the value of those things can actually grow faster than inflation, which protects and even builds their wealth.
Okay, so knowing this could be coming down the pike, how in the world do you prepare for it? Well, the analysis lays out a pretty straightforward three-step game plan to get yourself ready.
All right, step one is all about getting your foundation solid. That means you got to get out of what's called the financial danger zone. So you aggressively pay down any of that nasty high-interest debt, like credit cards, and then you build up a small emergency fund, at least a couple grand for those uh-oh moments. Okay, next, once your foundation is set, you build a system for your money. The 75-15-10 plan is a really simple way to think about it. For every dollar that comes in, a maximum of 75% is for your lifestyle, a minimum of 15% gets invested, and 10% goes to savings. The real key here is to make the investing part automatic, so it happens without you even thinking about it.
And that leads us to the final step. And honestly, it's the most important one. It's a total mindset shift. You have to go from just being a saver to becoming an investor. Because in the kind of world we're talking about, your savings are there to protect you, for sure, but it's your investments that are going to be the engine that actually builds your wealth over the long haul.
So all of this leaves us with one last, pretty provocative question to chew on. If our economy is being set up in a way where cash is literally designed to lose its value, has investing stopped being a good idea and become an absolute necessity? Thanks for watching this breakdown. If you want to keep learning how to navigate all these forces that are shaping the economy, make sure you subscribe to Stock Market Mojo. We'll catch you in the next one.